Pramod, let's talk about this. Do these reset mortgage rates now imply unaffordable levels, or how challenging is it going to be for consumers to service those loans, and what are the implications for NPLs and credit quality?
So you're right. I mean, effectively, we've had a situation in Singapore where there has been constant house price appreciation. There were cooling measures put in place which required, increased deposits, reduction in terms of the debt service coverage ratio. And all of those, what that did was to ensure that people were quite stretched on putting their down payments down, and then after that, looking to service their mortgages any which way they can. Now you have a rising rates environment. So what that does is that, households are going to look very carefully at where they're putting their money. And discretionary spending is going to start going down a fair amount. So things like just, shopping or eating out or travel, leisure, those activities are going to get curtailed. And what you're going to see is that focus of servicing the mortgage rates. Have rates increased, tremendously? Absolutely. So you have SIBOR moving into SORA, but SIBOR was at its peak at 3.5% in 2006. SORA, 3-month compounded SORA, is at about like 10.1 at the moment, but is jumping by anywhere between 30 and 50 basis points every month. And there's nothing to say that that trajectory is not going to slow down. So all in all, you're going to perhaps have rates which are, at least people haven't seen for about 10, 15 years. Some are saying 20 years. And that will cause some degree of stress on household budgets.
And who then is best positioned to withstand any potential uptick, Pramod, in non-performing loans, or are they all well capitalized?
They're all very well
to the Singapore banks.
They're all very well capitalized. They've got a lot of buffers in place for these kinds of situations. As I said, during COVID-19, the number of what I call management, the amount of management overlays, which are, you see a certain economic situation and then you provide for it. But then management says, hey, you know what? I'm really uncertain. I'm going to add a few more 100 million on top of that. So the management overlays have been huge at all three institutions, and therefore leading to, gigantic general provisions of the like of, 2.5 to, 4.2 billion across the different banks. And as I said, their income capacity is also increasing because net interest margins are increasing. So all in all, the banks are in kind of like bulletproof condition to take on board the undoubted increase in credit costs that we're going to be seeing in the coming years. Now, what tends to happen is that as households